Hello, dear traders. Last week was a rich in events, and all eyes were turned to the possible default in the United States. In fact, that was a storm in a teacup. Everyone understood that the parties would come to an agreement. However, there still were some risks and fears. Since the issue is settled, investors are switching to other news. However, the aftermath of the debt ceiling negotiations is still affecting the market situation. Traders need to understand how the deal may influence the U.S. economy. In the next few days, traders will focus on the macroeconomic situation and the Fed's policy. On a Friday, the U.S. Labor Department will issue a report where traders may find hints about the Fed's next decision. Although last week was rather negative for the stock market, all indexes except for the Dow managed to close in the green. At the end of the week, the situation was quite positive despite higher than expected PCE inflation. As a result, traders are betting that the Fed will remain hawkish and keep the key rate at the high levels for a long time. The concerns were elevated by the corporate data that allowed the NASDAQ to rise for the fifth week in a row. Watch this video review and share your opinion on the situation in the comments section. Global investors cannot predict how the preliminary deal on the rise of the U.S. debt ceiling may affect markets. The fact is that the debt ceiling is expected to be passed by Congress by the deadline on June 5. According to the compromise reached by the White House and the House of Representatives, the debt limit will be raised from $31.4 trillion, and this will allow the country to avoid a default and boost the appetite for risk assets. What's more, this decision will also support some sectors, such as cyclical stocks and small-cap stocks, and the fact is that they slumped because of a technical rally seen this year. Some investor fears that the extended cost reduction may affect the U.S. economic growth. Meanwhile, the negotiations that nearly brought the country to the verge of a default may undermine the reputation of the United States and rating agencies. The agreement on the debt ceiling is a positive news. However, the U.S. government still has problems with the money flows. It needs time to reach stability, and such difficulties may negatively affect the stock market. On the other hand, this may support the sectors that have lagged behind this year. Against the backdrop, investors may focus on the cost reductions' influence on the U.S. economy. It's still unknown how these changes will affect the country's GDP. Investors may also see volatility in the U.S. bond market. Once the debt limit is raised, the U.S. Treasury will quickly issue new bonds. This, in turn, will spur an outflow of cash from the market. On the one hand, traders will become optimistic about the deal and averted crisis. On the other hand, they will see a massive outflow of liquidity. As for the Dow Jones, on Friday, it jumped by more than 300 points, or 1%. The S&P also added 1%, while the NASDAQ increased by 1.4%. Traders were on a positive note as there was a lot of encouraging information. Various news sources wrote that the White House and Kevin McCarthy were approaching an agreement that should have raised the U.S. debt ceiling for the next 2 years. Investors should keep in mind that the project of the deal will be sent to Congress. It should approve the deal by the deadline on June 5. However, the document may face obstacles since some Republicans do not support the idea. What's more, in April, the U.S. inflation was stably high, whereas the country's economy remains strong. Judging by the PCE index data, in April, consumers spending more money on goods and services than in March. This points to the fact that inflation is still rising. Meanwhile, the consumer price index is reflecting its slackening. Thus, the PCE index report showed that spending surged by 0.8%. Given that the PCE index is the Fed's preferred inflation gauge, the warning signs of a solid inflation and consequently potential interest rate hikes cannot be ignored. Markets are now betting that the Fed will tighten policy rather than pause rate increases at its upcoming meeting in June. According to CME Group data, there is now a 56% chance for a quarter percentage point increase. 2 weeks ago, the probability was only 17%. The debt ceiling drama may soon be over. This means that the market is plunging back into a world of sticky inflation, high interest rates, and an ever-looming recession. This is hardly a welcome return to normalcy. Speaking of the S&P 500, it edged up on a Friday, notching its highest closing level since August 2022. In addition, the index posted strong weekly gains. Its year-to-date gain reached 9.5%. Uncertainty exerted periodic pressure on the stock markets in the past week, though most investors and analysts said they had expected an agreement later in the week. Optimism about the debt ceiling deal and a strong rally in artificial intelligence stocks helped the S&P 500 gain ground. Among the market sectors that are likely to benefit from the deal are defense stocks, which have lagged during the negotiations, as well as cyclical market sectors and energy stocks. The approval of this tentative deal is expected to help support the broader market, not just a number of big tech companies that have kept the market in a positive territory. Whatever the case, the S&P 500 must traded at around the technical level of 4,135 points. Buyers managed to push the index up, but only climb to the 4,300 area should be considered as a positive scenario. However, it requires strong driving factors. The labor market report may leave this level untouched, as investors will wait for the release of important data. Non-farm payrolls are estimated to have risen by 180,000 after an increase of 253,000 months earlier. The private sector payrolls are expected to have added 160,000 jobs. The unemployment rate is forecast to stand at 3.5%, up from 3.5% the month before. Average earnings are estimated to have risen by 4.4%. There are downside risks to the S&P 500. The 4,100 mark can be seen as a target for peers. The outlook for the S&P 500 is still gloomy, at least according to the UBS Bank. Economists believe that the negative impact, including that of tighter monetary policies on the corporate profits, will bring the index closer to 3,800 by year-end. The tech-heavy NASDAQ led the charge up last week, and now it has great upside potential. The technology sector distinguished itself with NVIDIA on everyone's lips. Its report cannot be called upbeat, as it showed a drop in revenues. However, the forecast of NVIDIA itself, which is much better than analysts' ones, appears to have impressed investors. As a result, NVIDIA shares surged by almost 30% after the publication of its earnings report. The company's capitalization made the second largest jump in the history of the stock market, having increased by more than $200 billion in overnight trading. Against this background, analysts at JP Morgan raised the price target on the chip maker to $500 per share. As for reports to be released this week, traders may take notice of those from HP Incorporated, Hewlett-Packard and Salesforce. The reporting session in the United States is coming to an end. Everyone is now wondering which securities to pay attention to. Artificial intelligence stocks are leading the market. The upside potential is great as investors are drawn to this topic. At the same time, 7 of 11 in the industries included in the S&P 500 index are currently in a negative territory, as in the case with the Dow Jones Industrial Average. Walt Disney and Alphabet should be excluded from the favorites. It's worth focusing on the US semiconductor ETFs to win back the tech sector and artificial intelligence topics. In general, one should consider a shortened trading week. The US market was closed in a observance of a Memorial Day on Monday. US jobs data is set to be released on Friday. If the labor market remains strong, this could have a negative impact on market sentiment by increasing the likelihood of a rate hike by the Federal Reserve, and the corporate component may have a less dramatic impact than it did last week. And we continue to monitor the situation so that you stay on the top of things. Subscribe to the channel and comment on videos. After all, we work for you, making the most relevant reviews every day and every week. And that's it. See you.